Hello everyone, and welcome back to Explain the Charts. Today is Tuesday, November 18th, 2025, and we're taking a close look at the Nasdaq 100 ETF, ticker symbol QQQ. The market has been incredibly volatile lately, and there's a lot of uncertainty in the air, so we're going to break down both the news and the charts to get a clear picture. First, let's talk about the current events shaping market sentiment. Recent headlines show a clear downturn, with reports of the Nasdaq sinking over 2% in tech-led routes just a few days ago. This weakness is happening as the market anxiously awaits a huge catalyst, Nvidia's earnings report, which is due midweek. This single event is seen as a major bellwether for the entire AI sector and, by extension, the tech-heavy Nasdaq. Adding to the uncertainty, we have conflicting views from major financial institutions. Morgan Stanley is suggesting a rolling recovery, predicting the market will move higher, while other experts like Jeffrey Gundlach are warning of a potential financial crisis brewing in the private credit sector. So we have this macro backdrop of a nervous market, digesting recent losses and bracing for a major news event that could swing us dramatically in either direction. Now, let's translate that sentiment into what we're seeing on the daily chart for QQQ. Looking at the bigger picture, we can see a very strong uptrend throughout most of the second half of the year, culminating in an all-time high of $637 set on October 29th. That $635 to $637 zone is now our key overhead resistance level to watch. Following that peak, we saw a sharp and aggressive pullback through the first half of November. This decline found a bottom last week on November 14th, right around the $597 level, which now serves as our most critical short-term support. The selling pressure during this drop was significant, which we can see from the elevated volume on the large red candles. For example, the drop on November 13th was on over 71 million shares, well above average, indicating strong conviction from the sellers. However, the bounce off the $597 low on November 14th was also on very high volume, nearly 80 million shares, which suggests that buyers saw value at that level and stepped in forcefully. Yesterday, on November 17th, the market closed down slightly at $603.66, showing some indecision as we consolidate between that recent high and low. Essentially, the market is coiling in a range, likely waiting for the Nvidia earnings catalyst to decide its next major move. Let's zoom in on this recent action to get a better look. Here on the daily chart, focusing on the last 3 months, you can clearly see the blow-off top formation in late October, followed by the breakdown in early November. The price sliced through several potential support areas before finding its footing near that $597 mark. An important intermediate level to watch for resistance is the consolidation area around $624 from late October. If the price can reclaim that level, it would be a very bullish sign. Conversely, if we lose the $597 support, the next logical area of support would be the swing highs from mid-September, right around the $590 level. Below that, we would be looking at the September lows in the $560 to $565 range as the next major support zone. Now let's switch to the 1-hour chart to analyze the very recent price action more closely. Here we can see the anatomy of the sharp sell-off last week and the subsequent bounce. The price fell dramatically on November 13th, but since the low on the 14th, it has been trying to form a base. Yesterday's price action shows the market is in a tight balance. We saw an attempt to rally in the morning, which was sold off, establishing a short-term resistance around $612. The rest of the day was spent in a narrow range, holding above the $600 psychological level. This shows a classic battle between buyers trying to defend the recent lows and sellers taking profits or initiating new shorts at minor resistance. For an even more granular view, let's look at the 15-minute chart from yesterday, November 17th. The market opened near the lows and immediately tried to push higher, reaching that peak near $612 around midday. However, sellers came in right there, and the price fell back down, giving up all of its morning gains. The latter half of the session was a slow grind downwards, eventually closing near the lows of the day. This short-term price action tells us that sellers are still in control on these smaller time frames, and any rally attempts are being met with resistance. The key for today will be to see if bulls can absorb that selling pressure and push back above yesterday's highs. So, let's switch back to the daily chart and recap everything. The market is at a critical juncture, caught between a recent powerful uptrend and a very sharp, recent correction. Your key price levels are clear. To the upside, immediate resistance is at the recent swing high of $612. Above that, the next major hurdle is $624, and the ultimate resistance is the all-time high around $637. To the downside, critical support lies at the $597 to $600 zone. A break of this level would likely lead to a test of $590 and potentially a larger drop to the $560 to $565 area. So, what are the potential scenarios? For a bullish case, we need to see a positive reaction to the Nvidia news. A strong earnings report could cause a gap up and a decisive close above $612. If that happens, I would put the probability of testing $624 at around 70%. For the bearish case, a disappointing report from Nvidia or bad economic data could easily cause us to break the $597 support. A daily close below this level on high volume would make a move down to $590 highly probable, say around 75% likelihood. The most likely scenario in the immediate short term is continued choppy, sideways action between $600 and $612 as the market holds its breath for that news catalyst. The thing to watch above all else is the reaction to Nvidia's earnings midweek. Watch the volume on that move. High volume will confirm the conviction of the new direction, whichever way it is. And finally, a disclaimer. This video is for educational and informational purposes only and should not be considered financial advice. Trading involves risk, and you should always conduct your own research and due diligence before making any investment decisions. Thanks for watching Explain the Charts, and we'll see you next time.